The beauty of the Dow theory for the 21st century is that it has several ways to derive sell and buy signals. We examine that we have the lows or highs of the last completed secondary reaction, which more or less triggers 10% of the time, as an additional way to derive signals when the normal pattern does not play out. But at the same time, the Dow theory for the 21st century has different alternative ways to derive buy and sell signals. And this is what makes it so powerful. So one of these alternative ways to derive signals is the so-called bull and bear market definition. Let's see what it is. We have the S&P 500. Let's imagine we are in a bear market. The market is going down and the market is going down. Suddenly, the market starts to go up, but we don't get the typical sequence of secondary reaction, pullback, highs. No, once again, something similar happens. The market starts to go up, but in this case, we don't have the highs of the previous completed secondary reaction because, as you can see, it really was going down in a straight line. So we don't have the alternative way we have just explained before. So what do? When do we decide that it's time to buy? Then comes the bull market definition to our help. You will have noticed that I only plotted the S&P 500 and the Dow Industrials because the bull market definition only depends on these two indexes. So we have a bear market, we don't have the privilege of having proper secondary reactions, and suddenly the market starts to go up and up. The bull market definition says that when both the S&P 500 and the Dow Industrials raise by more than 19% on both the S&P 500 and the Dow Industrials, then definition for a bull market has been met. Of course, when we are trading, for us, this is tantamount to saying that this is a buy signal. I insist that once again, we have the principle of confirmation. So if only one index rises by 19% of the last recorded lows, but the other one fails to confirm, let's say that the other one only rises by 17%, then we don't have the bull market definition. We need a raise of 19% or more on both indexes. The bull market definition is also important because it gives us the framework to discern whether the odds are high or low for a continuation of the bullish rally. In other words, it serves us as a timing signal, but also it gives us a broader picture. Because bull definitions, you can explore this further on the free area of our website, but bull definitions are coupled with significant price advances over the next 1, 2, and even 3 years. We could make the bull definition akin to cyclical bull markets. You know that we have several time frames. We have the secular bull market, the cyclical bull market, and then the primary bull markets. So they are smaller in orders of magnitude. So the secular bull market can last 5, 7 years, 10 years. The cyclical bull markets tend to last 2, 3 years and perfectly fits with our bull market definition. And then primary bull markets, which are the signals we get under the Dow theory, tend to last between, let's say, 8 months and 2 years. So this is important. So the bull definition is the third way we have to derive buy and sell signals. Remember, we had the normal 90% of the time way of deriving signals was secondary reaction, rally, pullback, all these things. The second was the lows or highs of the last completed secondary reaction. And now comes the third way to derive buy and sell signals. This is the bull definition, and now next we are going to explore the bear market definition.